Welcome to the deep dive.
Good to be here.
So today we're kind of taking a different angle on finance. We're pushing the spreadsheets aside just for a bit.
Yeah, we're diving into Morgenhausel's The Psychology of Money.
Yeah.
It really flips the script on what drives financial success.
It really does. Because it argues pretty convincingly that how you behave with money is way more important than how much, mathematically speaking.
Exactly. It's about emotions, your personal past, biases, all the messy human stuff that doesn't show up in a financial model.
Right. So our mission today is basically to unpack why we make the money choices we do, especially the ones that maybe from the outside look a little weird.
Or even completely irrational, yeah. But Housel argues they often make sense from the inside.
Let's kick off with that very idea then. He calls it no one's crazy. What's he getting at there?
It's fundamentally about perspective. He says your personal experiences with money, maybe things like seeing high inflation or growing up poor, they feel like 100% of how the world works to you.
Even though they're just a tiny sliver of actual economic history.
Exactly. But that tiny sliver shapes something like 80% of your financial worldview, your gut feelings about risk and reward.
Okay, so my background really defines my financial common sense. But hang on, does that mean every decision is okay? Like, is he saying there's no such thing as a truly bad financial move?
Not quite okay as in good, but understandable. He's pushing for empathy. Think about his example. People with low incomes buying lottery tickets.
Yeah, terrible odds. Financially irrational, right.
On paper, yes. But Housel suggests looking deeper. If your daily reality feels like a dead end, that lottery ticket isn't really an investment strategy. It's buying a tiny bit of hope, a dream of escape.
So it's rational within their context, even if not by spreadsheet logic. That makes a lot of sense. It shifts the judgment.
It really does. And it connects directly to the next big idea, luck and risk.
The inseparable twins. They play such a massive role. I mean, much bigger than we want to admit, right? Effort isn't always the deciding factor.
Absolutely not. Look at the Bill Gates story he tells. Brilliant guy, no question. But Housel points to the incredible luck of having access to that school computer at Lakeside. A 1 in a million opportunity back then.
Which set him on his path.
And then there's his friend, Kent Evans. Just as smart, just as ambitious.
But tragically unlucky, the mountaineering accident.
Exactly. Same potential, wildly different outcomes due to factors completely outside their control. One hit by luck, the other by risk.
It's a sobering reminder.
And Housel's point is we need humility when we succeed, acknowledge the luck, and self-forgiveness when we fail, acknowledge the risk. Believing it's all skill just sets you up for a fall.
Okay, so if success isn't just skill and our view is shaped by context and luck, that changes how we should think about goals. Which brings us to maybe the toughest question. What is enough?
This is such a crucial point. The danger of constantly moving the goalposts. Greed, basically.
Yeah, that story John Bogle tells about Kurt Vonnegut and Joseph Heller at a party.
Oh, it's brilliant. Heller points to some billionaire and says to Vonnegut, I have something he will never have.
Which is enough.
Just enough, knowing when to stop chasing more.
It's powerful because you see the opposite play out so disastrously, like Rajat Gupta goes from orphan to CEO worth $100 million.
And throws it all away, risking everything he had, everything he needed, for something he absolutely didn't need.
Why? Same with Bernie Madoff on a different scale. What drives that? Is it just pure greed?
It seems like it's often more about ego, status, and this insatiable desire that isn't really about the money itself. It's about comparison, maybe.
Yeah.
Fear falling behind.
So the antidote is managing expectations. Housel says happiness is results minus expectations.
Pretty much. If your expectations keep rising faster than your income or wealth, you'll always feel like you're falling short, no matter how much you actually have.
Okay, so if more isn't the answer, what should we be aiming for with money? What's its real value?
Control. Housel argues the highest dividend money pays is control over your own time. Autonomy.
The ability to wake up and say, I can do what I want today.
Exactly. That flexibility is the real prize.
Yeah.
There's that psychologist, Angus Campbell. His research found that having a strong sense of controlling your life is a more dependable predictor of happiness than your salary or how fancy your job title is.
That really resonates. I think we've all seen or known people in high-paying, high-prestige jobs who seem kind of miserable.
Because the job owns them, right? It demands all their time, blurring the lines between work and life. The high pay comes at the cost of autonomy. So are you really wealthier in terms of life satisfaction? Maybe not.
This leads nicely into another key distinction Housel makes, one we often mess up. The difference between being rich and being wealthy. They sound similar, but they're not.
Not at all. Rich is visible. It's the high income, the flashy spending, the expensive car, the big house.
Like that example, Roger, with the Porsche. Looked rich.
But it got repossessed. He was living on the edge, all show. That's rich.
And wealth.
Wealth is hidden. It's the money you haven't spent. It's the savings, the investments, the assets working quietly in the background. Wealth is what gives you options, flexibility, that control over time we just talked about.
Which ties into his man-in-the-car paradox. Explain that one.
Right. So you see someone driving a really fancy car, say a Ferrari. You might think, wow, that driver must be cool, or admire them.
Yeah.
But Housel argues what usually happens is you think, wow, if I had that car, people would think I'm cool. You admire the car and imagine yourself in it. You don't actually admire the person driving it all that much.
Huh. That's probably true more often than not. We admire the possession, not the possessor.
Exactly. So if you're buying expensive things to get respect, it usually backfires. People admire the thing. Real respect comes from, kindness, humility, empathy, not horsepower.
So if wealth is hidden and saving is key, Housel argues that your savings rate matters more than your income or even your investment returns. That feels counterintuitive.
It does, but think about it. You can earn a huge income, but if you spend it all, you're not building wealth. You're just rich for now, somewhat earning less but saving a significant chunk. They're building that hidden wealth, that future flexibility.
Spending beyond a certain point is just ego.
Often, yeah. Ego approaching income, as he puts it. The more you make, the more you feel you should spend to show it. Breaking that link is crucial.
And he stresses saving without a specific goal in mind, just saving for saving's sake.
Yes, because life is unpredictable. You don't know what opportunities or emergencies are coming. That unearmarked saving gives you a buffer, resilience, the ability to weather storms or seize unexpected chances. It's a competitive advantage.
Okay, let's talk about actually growing that wealth over time. Compounding. We hear the word, but do we really grasp it?
Probably not intuitively. Our brains like linear thinking step by step. Compounding is exponential. It's slow, then sudden. And the key ingredient is time, duration.
The Warren Buffett example here is just mind-blowing.
Isn't it? Of his, $84.5 billion net worth, $84.2 billion came after his 50th birthday.
Wait, say that again? Like almost all of it?
Almost all of it. He was already successful, a millionaire many times over by 50. But the truly astronomical wealth came from decades more of just letting it compound.
So the lesson isn't be as brilliant as Buffett, it's be as patient as Buffett. Stick around.
That's a huge part of it.
Yeah.
Good, solid returns sustained for the longest possible time. Longevity trumps high-flying, short-term genius almost every time.
Which means you absolutely have to survive to benefit. This leads to his point about getting wealthy versus staying wealthy.
Yes, they require totally different mindsets. Getting wealthy might involve taking risks, optimism, maybe a bit of daring.
But staying wealthy.
That requires humility, frugality, even a degree of paranoia. You have to protect the downside because you can lose it all much faster than you made it. Survival is paramount.
So avoid ruinous debt. Don't panic sell in downturns. Just stay in the game so compounding can do its thing.
Exactly. Don't get knocked out. Which brings us to the need for a margin of safety.
Benjamin Graham's idea, right? Building in a buffer.
Precisely. Worship room for error, as Housel puts it. Don't cut things so fine that one unexpected event blows up your whole plan. Having cash reserves, not being fully invested or leveraged to the hilt, that makes you financially unbreakable.
So you don't have to sell at the worst possible time during a crash. You can ride it out.
You can endure. You don't need perfect forecasts if you have a buffer. It's like that barbell strategy idea. Be optimistic about the long term, maybe invest for growth, but pair it with extreme conservatism, like holding cash, to survive the unpredictable short-term storms.
Plan on the plan not going according to plan.
That's the essence of it. Be prepared.
Okay, so pulling all these behavioral threads together, what's the big mental shift Housel wants us to make?
It's about aiming to be reasonable rather than purely rational.
What's the distinction there? Rational sounds good.
Rational, in finance theory, means making the mathematically optimal decision every single time. Buy low, sell high, no emotion. Perfect logic.
Which sounds, well, robotic and not very human.
Exactly. A reasonable approach acknowledges you're human. You have emotions, fears, changing goals. So the best strategy isn't necessarily the one with the absolute highest potential return on paper. It's the one you can actually stick with. psychologically, through thick and thin, for the long
The
haul.
one that lets you sleep at night.
That's the key. Sustainability over theoretical perfection.
So if we boil this down, what are the top, say, 3 actionable things you should take away from this deep dive?
Okay, first, make wealth the goal, not richness. Focus on building those unseen assets, that financial cushion, rather than just displaying status through spending. It's about future options, not current flash.
Got it. Wealth over ego. Second,
Use money to buy control over your time. That autonomy, that flexibility, value it highly. Maybe more highly than the next pay rise if it comes with strings that reduce your freedom.
time is the ultimate currency. And third,
Except that you'll change. Your goals, your desires, they aren't fixed. So avoid making super extreme financial commitments today, locking yourself into a path that your future self might really regret. Build in adaptability.
that's huge. Don't plan too rigidly for a future you who doesn't exist yet. Okay, let's wrap up with that final provocative thought House leaves us with. It's about understanding the game you're playing.
Right. Financial bubbles and crashes happen, partly because people with totally different goals and time frames are all playing in the same market, looking at each other for cues.
Like a day trader watching a pension fund.
Exactly. The day trader cares about the next few hours. The pension fund cares about the next 30 years. Their actions are driven by completely different things. If the long-term investor starts panicking because the short-term trader is selling, disaster.
So the takeaway for you, the listener.
Know your game. Define your time horizon. Define your strategy. Are you saving for a house in 5 years? Retirement in 40? Trading next week? Once you know your game, you're less likely to be swayed by the noise made by people playing a completely different one.
Don't let someone else's sprint derail your marathon.
Perfectly put. Focus on your own race.